In today's video, we're going to be discussing how interest rates affect the stock market and why it's important for investors to understand this relationship. Interest rates are the cost of borrowing money. When interest rates are low, borrowing money becomes cheaper, which means companies and individuals can take out loans more easily. This can lead to increased spending, which can boost economic growth and drive up stock prices. On the other hand, when interest rates are high, borrowing is more expensive, which can slow down economic growth, which often leads to lower stock prices. As you can see from this graph, there's a clear correlation between interest rates and the stock market. When interest rates are low, the stock market tends to perform well. When interest rates are high, the stock market tends to perform poorly. But why is this the case? First, businesses often rely on borrowing money to grow. When interest rates are low, companies can borrow money more easily and invest in growth opportunities like research and development, new products, and marketing campaigns. This can lead to increased profits and higher stock prices. For example, let's say there's a manufacturing company that wants to invest in a new product line. If interest rates are low, they can take out a loan to fund this investment at a lower cost. This can help them increase their production and drive up their stock price. On the other hand, when interest rates are high, borrowing money becomes very expensive. This can make it much harder for the companies to invest in these growth opportunities, which often leads to lower profits, which leads to lower stock prices. Interest rates just don't affect businesses, they also impact consumers. When interest rates are low, it's easier for consumers to borrow money to buy homes, cars, and other big ticket items. This can boost economic growth and drive up stock prices. For example, when interest rates are low, a family might be able to afford a larger mortgage payment and buy a bigger house. This can stimulate the housing market and drive up the price of construction companies. On the other hand, when interest rates are high, borrowing becomes more expensive for consumers, which can lead to a decline in spending and slower economic growth. An example of this could be if a family is trying to buy a new vehicle. When interest rates are low, they may be able to afford more of a monthly payment, but as interest rates rise, many families get priced out of buying new vehicles. Another factor to consider when examining the relationship between the stock market and interest rates is the role of government policies. When the economy is weak, the government often lowers interest rates to stimulate borrowing and spending. This has the effect of increasing the money supply and driving up prices, including stock prices. On the other hand, when the economy is strong and inflation is a concern, the government may raise interest rates to slow down borrowing and spending, which can cause a decrease in stock prices. It is important for investors to be aware of the government policies and how they might impact interest rates and the stock market. For example, when the Federal Reserve announces that it plans to raise interest rates, it can cause a sell-off in the market as investors become concerned about the potential impact on the economy and corporate profits. On the other hand, when the Fed signals that it plans to keep interest rates low for an extended period, it can boost investor confidence and lead to higher stock prices. Now let's look at a real-world example of how interest rates can impact the stock market. In early 2022, the S&P 500 hit a record high. However, in the following months, it began a downward trend, falling by over 23% by mid-June. One factor contributing to this decline was a rapid rise in interest rates in response to a surge of inflation. This led to a decline in investor confidence and fears of an economic recession. The decline in the stock market had a ripple effect on the broader economy as companies began to cut back on spending and hiring. The United States gross domestic product shrank at an annual rate of 1.6% in the first quarter of 2022, according to the Bureau of Economic Analysis. This contraction was driven in part by the decline in corporate profits resulting from the stock market downturn. The relationship between interest rates and the stock market is complex, but important for investors to understand. Investors should be prepared to adjust their investment strategies accordingly. By staying informed and taking on a long-term investment view, investors can navigate the ups and downs of the stock market and build a strong, diversified portfolio for the long term. Thank you so much for watching. If you haven't subscribed already, please consider doing so. I have a ton of new videos coming out that you won't want to miss. If you're not sure what to watch next, check out this video right here that YouTube is recommending. I think you will really enjoy it. Take care, and I will see you next time.